I have a confession to make.
Oh, yeah.
Usually, if you wanted to clear a room at a dinner party or, I don't know, put a colicky baby to sleep, you'd just start talking about Japanese government bonds.
Right, JGBs.
JGBs, historically, they're like the single dullest topic in the entire financial universe.
It's certainly right up there. For decades, trading JGBs was the financial equivalent of watching paint dry. We used to have a joke in the industry that the JGB desk was where excitement went to die.
Exactly. It's where careers went to hibernate. But something weird is happening. Lately, if you open up your newsfeed, the algorithms are just screaming about Japan.
Oh, absolutely.
I'm seeing thumbnails with, fire, red arrows pointing downwards like collapse, the end, crisis.
Yeah.
So I'm looking at this and I'm thinking, wait a minute.
Yeah.
Is the most boring market on Earth suddenly the most dangerous? Because the vibe shift is intense.
It's a really jarring shift. You go from 30 years of absolute stillness to headlines predicting the apocalypse next Tuesday. It's a lot of whiplash for the average person.
Right. And that's exactly why we're doing this deep dive. Because if you actually look at the charts, not the thumbnails, but the raw data, it doesn't look like a cliff. It looks like, well, a shift.
A change in state.
A change in state. So for everyone listening who's trying to figure out if they should be, panic buying gold or just ignoring the noise, what is actually going on?
That is the mission for today. We have a fascinating set of documents to work through, specifically a report codenamed ECP-6R2. And the core argument here is pretty refreshing because it steps away from the hysteria.
Okay.
It argues we need to stop looking for a collapse and start trying to understand what the source calls an OS update.
An OS update, like updating your phone software.
In a way, yes. The global economy, and Japan specifically, is going through this massive operating system update. The thesis isn't that the system is crashing, it's that we're seeing the end of a very specific expectation model.
An expectation model.
We're moving away from a world where basically endurance was the only thing you needed to succeed.
Endurance. That's a very specific choice of words. So, okay, before we get into the scary headlines and the hyperinflation talk, we need to understand what we're updating from.
We need the baseline.
We need the baseline. We're not going to doom scroll here. We're just going to do a calm, reflective observation of the machinery.
Precisely. Let's look at the engine before we panic about the noise it's making.
Okay. So let's unpack this endurance model. What was the old operating system that was running Japan and really the world for the last 30 years?
To get the endurance model, you have to understand the asset itself. Japanese government bonds were a very specific kind of tool. They yielded almost nothing. You bought them, you got practically zero return.
Sometimes less than zero.
Sometimes less than zero, which, on the surface, sounds like a terrible investment. Why would any rational person park billions of dollars in something that pays nothing?
I mean, I wouldn't put my savings in a bank account that pays zero if I had other options.
Of course not.
Yeah.
But it was because they were safe.
Yeah.
And this is where the endurance model really comes in. The source material, it defines the logic perfectly. It says, if you wait long enough, it works.
If you wait long enough, it works.
It was a model based on this idea that if you have enough time and enough institutional protection, you don't really need high returns. You just need stability.
So it was the ultimate set it and forget it.
Exactly. But think about the conditions you need for that to be true. You needed ultra-low interest rates, basically zero.
Right.
You needed high domestic ownership, so Japanese banks and insurance companies were buying their own government's debt.
Yeah.
It basically locked the capital inside the country.
Yeah.
And most importantly, you had massive policy stability. The Bank of Japan just said, we will not let this price move, period.
Right. They call this yield curve control in the textbooks, but in practice, it just meant the central bank was a backstop for everything.
It was the widowmaker trade. You remember that term?
Yeah. Oh, absolutely. For years, these big hedge fund managers would bet against Japanese bonds, thinking this can't last, rates have to go up, the debt's too high, and they all lost money.
They got wiped out.
Wiped out.
They got wiped out because they didn't get the endurance model. They were betting on economics. Japan was running on structure. The logic was, Japan will endure. The price won't move because the institutions have agreed it won't move.
So it was an asset that didn't require you to be smart, it just required you to be patient.
Time and institutional protection. That's the phrase the source uses, and here's why this matters to you, even if you're not in Japan. This became a foundational brick for the entire global financial system.
This is the carry trade, right?
Correct. Global banks, hedge funds, everyone used Japanese bonds as a stable anchor. You could borrow money for free in Japan, basically, and invested in U.S. tech stocks or Brazilian bonds or whatever.
It was free money.
It was free money, provided you trusted that one single assumption. Japan will never change.
If you wait long enough, it works. Okay, so that's the old OS. It ran the world for 3 decades. What happened? Did the phone brick?
No, nothing broke. But the condition became conditional. That's the crucial distinction the source makes.
Conditional.
Recently, we've seen ultra-long-term yield bonds that mature in 30 or 40 years start to move meaningfully higher.
And just for clarity, in the bond world, when yields go up, the price of the bond goes down.
Right. And suddenly, the market is sending a signal. It's saying, we are no longer accepting time as the only solution to low returns. We're not just going to wait it out anymore.
Why not?
Because the environment has changed. Inflation is back. Energy costs are volatile. The cost of just waiting has gone up.
I want to highlight a catchphrase from the source material here because it really stuck with me. It says, a model based on endurance has become conditional.
That's the key. It doesn't mean the bonds are now toxic assets. It doesn't mean Japan is bankrupt. It just means the era of automatic safety is over.
You can't just assume that time will solve the problem anymore.
Now you have to look at the conditions.
So it's like, imagine you have a very reliable old car. For 20 years, you never checked the oil, never changed the tires, and it just ran. That was the endurance model.
Right.
Now the car still runs, but suddenly you have to actually check the engine light. You have to do maintenance. It's not broken, but it's no longer magic.
That is a perfect analogy. And this brings us to why the internet is freaking out. Because if you spent 30 years believing the car is magic, that it runs on willpower, and suddenly the check engine light comes on.
You assume the car's about to explode.
Exactly. Which leads us perfectly into part 2. The noise, the panic, what the source calls arbitrary gradients.
Arbitrary gradients. It sounds technical, but it's a brilliant concept.
It really is. It explains why there is such a gap between the reality and the headlines.
Yeah, let's talk about that gap. Because if I look at social media, they are talking about hyperinflation, currency collapse, the end of the yen. Why is the narrative so extreme if this is just a repricing of risk?
Yeah. The source breaks this down into 2 layers. First, you have the media video layer. This is where those arbitrary gradients live. And the goal of this layer isn't accuracy, it's attention.
Right.
And the best way to get attention is to compress timelines.
Compressing timelines? What do you mean?
Think about a chart. If you zoom out, a shift in interest rates from 1% to 2% over 5 years looks like a gentle slope.
Okay.
But if you crop the chart to just the last week and you stretch the y-axis, that same move looks like a vertical wall.
Right. It looks like a crash, like the chart is falling off the table.
Exactly. They take a structural shift that might play out over 10 years, a slow, grinding change, and they frame it as something happening next Tuesday.
It's the collapse narrative.
They generate emotional anxiety to get the click. The yen is at 150, next stop 200, next stop 0. It turns a complex economic adjustment into a blockbuster movie script.
But if you look at the second layer, what the source calls comprehensive recognition, you see what the actual markets and institutions are thinking.
And there's a quiet consensus forming there that is totally different from the YouTube panic.
So what are the big money players actually thinking? If they aren't panicking, what are they doing?
They aren't thinking fear. They're thinking sober realization. The consensus is Japan is still special, but it is not an infinite exception.
Not an infinite exception. That feels profound.
It is. For a long time, Japan was treated as an exception to economic gravity. They could have massive debt, an aging population, 0 growth, and nothing bad ever happened.
Right.
The market is now just recognizing that gravity applies to Japan, too.
There was a detail in the source that I found really fascinating here. It mentioned that for the first time in ages, the prices of these bonds are starting to reflect politics and fiscal reality.
Yes. This is huge. Previously, the price of a Japanese bond was determined by one thing, the Bank of Japan saying the price is X.
It was God mode.
Exactly, like a video game cheat code, infinite ammo. But now, the central bank is stepping back slightly. They're letting the market breathe.
And when the market breathes,
it starts to sniff around. It starts to price in messy things like, hey, the government spends a lot of money, or hey, inflation is sticky.
So the God mode cheat code is being turned off, and now they have to play the game on normal difficulty like everyone else.
And that is scary if you're used to God mode.
Yeah.
But it's not a disaster. It's a return to reality. The difference between a controlled descent and a crash. The internet sees a crash. The professionals see a difficult, turbulent landing.
Okay, So we've established it's not a crash, it's an update. We've established that the market is just waking up to gravity. But I want to zoom out because you
Well,
and I always say this, finance isn't just numbers on a screen.
absolutely. It's a reflection of society.
Hmm.
Bonds are just a mathematical expression of a social contract.
So what? What does this mean for the country? This brings us to the concept of the hardened trajectory. This was the part of the deep dive that really made me sit up. It felt almost sociological.
It's the deepest insight in the source material, I think. The report argues that this isn't just about global inflation overwhelming Japan. It's about how Japan survived the last 30 years.
How did they survive?
By adapting. But, and here's the twist, they adapted too well. To maintain stability in a volatile global world, Japan hardened its internal structure.
Hardened. Unpack that for us. What does that look like on the ground?
Well, think about it. Japan wanted to participate in the global economy. They export cars, they buy energy. But they didn't want the volatility that comes with it.
Right?
They didn't want massive layoffs or wild swings in inequality or the chaos we often see in Western economies.
So they used their financial system to buffer that.
Exactly. They used these low-rate bonds, this endurance model, to act as a massive shock absorber. They suppressed yields to keep financing costs low for companies so they wouldn't have to fire people. They kept the currency stable.
But if you keep a shock absorber compressed for 30 years, it freezes. It becomes part of the frame.
That is the perfect description. The source calls this a stable but hardened state. Japan opened up to global finance but locked down its internal social and economic motion to survive it.
It's a paradox.
Yeah,
Global integration via internal rigidity.
it is.
I love the visual analogy here. It reminds me of, okay, imagine a tree in a very windy place. To survive the wind, the tree grows incredibly thick bark and stiff branches.
Okay.
It survives the storm, it doesn't fall over, but because it became so rigid, it can no longer bend. If the wind changes direction, that rigidity becomes a liability.
That is the image the source is evoking. The endurance model was the thick bark. It protected the society, it kept unemployment low, it kept things stable while the rest of the world was going through financial crises. But the cost was flexibility.
You sacrifice dynamism for durability.
And now the wind has changed direction. The global inflation wind, the interest rate wind, it's blowing from a different angle, and a hardened trajectory cannot easily pivot.
You can't just suddenly become a dynamic, high-growth, high-turnover economy overnight.
Why?
So usually when people talk about this, they frame it as a binary choice. I see this in the op-eds all the time. Japan must globalize fully, or Japan must close off and protect itself.
Right, the classic globalist versus nationalist debate. But the source rejects this entirely. It says turning inward is a degraded copy of the past.
A degraded copy.
You can't just close the doors. You can't go back to the 1980s. The supply chains are too integrated. The demographics have changed too much. Isolation isn't a viable alternative. It would just lead to poverty.
So they can't go back, but they're too stiff to move forward easily.
Precisely. The stable but hardened trajectory has reached its limit. And I think it's really important to emphasize, it wasn't a failure. It worked for 30 years.
It provided a high quality of life.
A very high quality of life.
Oh.
But that specific way of moving through history effectively has an expiration date.
It's like the update we talked about at the start. You can run Windows 95 for a long time. It's stable. It works. But eventually, the new software just won't run on it.
And we are seeing that friction now. The rise in bond yields is just the heat generated by trying to run new software on old hardware.
So what does this mean for the listener? If this isn't the old stable Japan, but it's not Mad Max collapse either, what is it? How should we look at this asset class now?
It's a period of negotiation. We have to reevaluate the asset and, by extension, the country. The source suggests we need to watch new variables. We have to separate the analysis into conditions, time frames, and roles.
Okay, let's break those down. Conditions.
Policy, demographics, physical health. These things actually matter now. Before, time smoothed everything over. It didn't matter if the population was shrinking, the bond yield was zero.
Right.
Now, if the demographics are bad, the bond price might actually reflect that risk. We have to do actual fundamental analysis again.
Time frames.
Short-term versus long-term. In the old model, they were the same. Just wait. Now, the short-term might be highly volatile, while the long-term remains stable, or vice versa. They behave differently.
And roles, what does that mean?
This is the interesting one. Is the bond a stabilizer or an adjustment asset? Before, bonds stabilized the system. They were the anchor. Now, the bond market might be the thing forcing the system to adjust. It's the difference between the anchor and the sail. If the bond yield rises, It forces the government to change its budget. The tail is wagging the dog.
That brings us to the big question, the one that usually gets left out of the economic textbooks. If the expectation model has changed, if we can't just endure our way to success, who pays for the adjustment?
That is the critical question raised by the source. The costs of this adjustment have to be borne by someone. The endurance model was basically a way to defer cost into the future. Well, the future is here. So who takes the hit?
Let's walk through the options. Is it the government?
They could cut spending or raise taxes. But in a hardened society with an aging population, cutting benefits is political suicide.
Okay, so probably not them. Is it the market?
Do stock prices fall? Do bondholders take a haircut? That cleans up the balance sheet, but it destroys wealth and pensions.
Or is it the lived experience of the people?
That's the inflation piece. If the government won't cut spending and the market won't crash, often the currency devalues. That means the cost is paid by the regular person at the grocery store.
Your salary just buys less.
Your salary buys less. That is a form of paying down the debt. You're just doing it through purchasing power rather than taxes.
It feels like that's already happening, right? The yen has been weak. The quiet consensus you mentioned earlier seems to be leaning toward that option.
It's often the path of least resistance politically. It's invisible taxation. But the source warns us. This is where the hardened trajectory is dangerous. If you put too much pressure on the lived experience of a society that is already rigid,
Things can snap.
things can snap. If the tree can't bend, you push it too hard.
Yeah.
Social unrest, political instability, these are risks that were effectively zero under the old model, but are now non-zero. The rigidity that saved them is now the source of the risk.
This has been, wow, a lot deeper than just buy or sell. Let's try to summarize this journey because we covered a lot of ground.
We did.
We started with boring bonds and how the internet turned them into a panic crisis.
And we debunked that. It's not a crisis, it's a repricing.
Then we looked at the structural update, the shift from an endurance model where time heals all wounds to a conditional model where reality actually matters.
And we saw that this isn't a failure of Japan, but the result of adapting too well, creating a hardened trajectory that is now struggling to bend.
And finally, we're left with the bill. Someone has to pay for the update, and it looks like the currency and the consumer are currently in the crosshairs.
And I want to leave the listener with one reflective thought.
Mm-hmm.
We've been talking about Japan this whole time. But if you look around, isn't this happening everywhere?
That's true. The U.S. has high debt. Europe has aging demographics.
The era of unconditional stability provided by ultra-low interest rates is ending for all advanced economies. We're all moving from endurance to conditional.
So Japan is just the canary in the coal mine.
They started the endurance model first. They entered the future 20 years before us.
So watching Japan isn't just about watching a foreign market. It's about watching our own future play out.
Exactly. We are watching a live experiment in how a post-growth, high-debt society updates its OS. It's the most important economic show on Earth right now.
I will want to end with the provocative thought from the source material. We usually ask, should Japan be global or inward? But the source says that's the wrong question.
The real question is, how can a hardened trajectory be loosened and redefined without breaking?
That is the challenge. How do you stretch a stiff muscle without tearing it?
That is what the next decade of economics is going to be about, not just for Japan, but for the entire developed world.
Well, on that note, something to chew on while you look at those scary YouTube thumbnails. Don't fall for the collapse, but respect the update.
Observe the gradients. Watch the timelines.
Thanks for stepping into the deep dive with us. Keep your eyes on the news this week. See if you can spot those narrative biases versus the quiet consensus. We'll catch you next time.